Okay, hey there, Lincoln here from bullacademy.org. Today is January 1st of 2022. It's been a great year, and yesterday I covered a review of my 2021 and of 2021 itself, all the craziness that happened yet last year. But in that video, I said that I was down 15% from last year to now. Year over year, down 15%. I make it a point on this channel, bullacademy.org, to be very honest and transparent with all of you about my portfolio, because the idea is that we're all on this journey together, building long-lasting, sustainable wealth by practicing the bull mentality. And I've covered the bull mentality many times, but this video, I'm trying to focus on something else right now, right? On setting the record straight, because I don't want people to confuse my transparency and my honesty with failure, because not everyone tells you their failures, their down days, right? Their down months and their down years, because everyone has it, but it's not a positive thing to share on YouTube or on the social networks, because people just want to see the successes. People want to see that you're up 10,000% on some meme coin, or you got into GameStop or AMC early and you rocketed overnight. But that's not the truth of investing. Investing, for most people, the vast majority of people out there like yourself, is a long-term game unless you want to burn out and fizzle and lose a lot of money real quick by trying to chase quick wins. But the people on TikTok and Instagram and all of those other social networks, they only show you the quick wins that they have, if it's even theirs, right? Not everyone's telling you the truth. The truth really is that everyone's portfolios goes up and down. And unfortunately, many people's portfolios, because they're trying to chase quick wins, especially because they're being pumped all this garbage on social networks about getting rich quick, their portfolio goes like this. It just falls down. Or it's like this, to the right, right? To the right and down, and not up. Because they're trying to get rich quick, because all they know from the social network is that the stocks only go up. But that's not true. Stocks go up and down. And especially for someone like myself who is investing aggressively, my portfolio is very volatile, and more so because I'm so concentrated in my portfolio. In 2021, I had 7 stocks, and those accounted for 98% of my portfolio. In 2022, right now, I have just 3 stocks. 3 stocks that account for 96% of my portfolio. That means that any single move in any of those stocks is going to make my portfolio move heavily in up or down direction. And that's how I like it, because I've explained many times on this channel that I don't want the bad stocks in my portfolio. I don't want to invest in indexes or a whole bunch of stocks so that my wins and my losses can offset one another. Because when you take the top, you take the bottom, you get the middle. That's mediocre returns. And I've explained that it's simple math, right? It's an average. Average is mediocre, and it keeps you poor, right? Unless you have lots of money and you're investing for a very long time and your plan is to retire when you're 65 or 70, you probably don't want to be too diversified. So I don't take that route. And I also don't take a very conservative route, even when it comes to concentration. You can concentrate your portfolio with 10 stocks, which is where I started. I had about 10 stocks in 2020, and then I went down to 7, and now I'm down to 3. And the reason for that is because I want to retire much earlier than the regular retirement age of 65 or so. I'm trying to retire by the time I'm 40. I want to be able to retire. I probably won't be retiring anytime soon, but I want an option to. And the way I'm going to do that is by investing aggressively in my top conviction stocks and my own businesses and my friends and other people's businesses that I believe in, right? But in a very concentrated manner, in a way that I understand each company very well, each investment very well, right? Each property that I buy, real estate property, like this one that we bought last year in 2020. So I'm very concentrated, but that comes with drawbacks, right? That comes with risk, and the risk is hyper volatility. And if in the actual risk there, because volatility isn't a risk, the risk is your emotions. The risk is that you might not be able to handle that. Yeah, you might see your portfolio drop 40% in a single month, and you're gonna freak out and sell all your stocks and exit and then stay poor. That's the real risk of volatility. Volatility itself is not a risk, it's just the sentiment of the market at any given time. So my portfolio goes like this. Any given day, I might go up 10, 20%. I might go from negative to positive, and heavily so. So yes, I am down 15% from January 1st, 2021 to now January 1st, 2022. But that's not the full story. The full story is that I am down or up positive every single day. My portfolio jumps, and I show my patrons at patreon.boacademy.org in our Discord channel, where we discuss the stock market in real time every day. I show them my portfolio updates as soon as I make any trades. So they've seen all my portfolio movements last year. Days that I will be up 20% or even 15, 10% in a single day, or be down in the morning by 10% or 15%, and then end the day up 20%. That's how volatile my portfolio is because of how hyper concentrated it is. And of course, it's not for everyone. It's highly risky because you need to be able to manage your emotions and handle the swings in your portfolio value. If you can't handle seeing your portfolio drop by 50% in a given month, you might not be able to do a concentrated portfolio like this. And that's fine. It's not for everyone. But you have to understand that not being concentrated has a drawback too. Is that you're diversified or overly diversified, and you're going to get the average returns. Of course, that will work out over a long term. And if you stay invested for 20, 30, 40 years, you will have a much higher chance to retire than people who aren't investing at all and are losing their money to inflation at 2% or 3% or this year 6% per year. So if you're invested, however you are, be that in S&P 500, very broad market index, or be it a concentrated portfolio of 10 stocks, or a hyper concentrated portfolio of 5 or 3 stocks like myself and other investors who believe in hyper concentration and are invested, in one stock. Some people are invested in just Tesla or just Lucid Motors or just whatever stock that they believe in, like ChargePoint. So there are companies out there that are multi-generational and that are transformational. They are doing things that are going to disrupt their industries and really change the game. Those are the companies that I look for when it comes to concentration. And I have 3 of them, right? At least 2 that I'm definitely sure are going to be here for the long term, at least for my assessment. Of course, I don't know the future, but that's why I'm so comfortable investing in those companies, and because I trust my own judgment, right? And so I had some commentary in my comments yesterday saying, oh, you're down 15% over the year, but S&P 500 is up 25%. That's great, but the S&P 500 averages about 10%. It's pretty much a steady investment, and that's great. It's gonna outpace most investors who try to choose their own stocks, but not everyone. I'm crushing the S&P 500. There's no question about it. I'm going to show you the numbers now to show you why I choose this path that is less traveled. And you'll see why I'm not concerned about being down 15% as of this moment, because tomorrow I might be up 50% year over year, right? Like literally tomorrow when the market opens up. So with all that said, let me walk you through the numbers. But right before we do that, if you enjoy these videos and if you want to support the channel and help us continue to make videos like this, then do me a favor and like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts. Let me know how you're investing in your portfolio. Let me know how diversified you are, how concentrated you are, what your plan is, how you're approaching your journey, your unique journey to building your wealth and working towards retirement, which is not guaranteed. You have to invest in order to get to retirement. Retirement is not some magical day in the future. It's a time when you have enough money to cover your expenses so that you can live the life that you want to live on your terms. That's all it is. So some of us have different approaches. All of us have different approaches to reaching that point in our lives. So I want to hear from you. What is your plan? How are you doing it? Do you agree with my approach? Do you disagree? Why? Tell me what stocks are you invested in? What's your plan for 2022? I would love to hear from you. You will hear all of those questions answered from me over the course of this year. So I appreciate all of your engagement. Again, share with a friend and help this channel reach our goal of 10,000 subscribers this year. And of course, if you want to get more access to me and engage on Discord channel where we discuss the stock market in real time every day, then join us over at patreon.bullacademy.org. Our patrons keep this channel going with their financial support and their engagement in the Discord channel. So if you would like to become one of our patrons, I would love to see you over at patreon.bullacademy.org. Thank you, and now let's hop back in. Okay, so let's pull out my handy dandy Remarkable, which I absolutely love, and this video is not sponsored. I don't have any sponsors besides you and our patrons. So this is just because I love this tool. Remarkable is like a piece of paper that I write on. Do you hear that? So I've done some math here to show all of you and to set the record straight with some numbers and share with you how my concentrated portfolio works, how volatility affects this portfolio of what used to be 12, 10 stocks, taken down to 7 in 2021, down to 3 as of now in 2022 to start the year. So I started investing on the stock market. Of course, I've been investing since I was a kid in high school, building my own businesses and all of that, been an entrepreneur my whole life. But on the stock market, I've been investing since 2019 when I left my job and started a business from college. I took all my money and I put it into the stock market. I took half of it actually. I put it into the stock market and used the other half to live off of and build another business. And that was May 24th, 2019. I started off with about $5,000 and added more over that month. I started investing in Tesla and all of that. Tesla Beyond Meat and Cloudflare, which is the only company that's here still from the start. So I want to start from now and work backwards and then work forwards to where we're going to May 24, 2022, which is when I will assess my third year of performance on the stock market. So I want to walk you back to January 1st of 2021. At that time, I had 7 main stocks. They accounted for 98% of my portfolio. I had 12 in total, right? So 5 of them were just trying to see if I would like to keep them for the long term. At that time, I had about $183,000 in equity in my growth stock portfolio on January 1st, 2021. Today, I have about $154,000. So that means I'm down about 16% or so. Okay, that's great. I'm down, right? And that's what I say. I want to be honest with you on this channel. It's not going to be just up. You're going to have volatility, and that's fine. You have to just be able to manage it. So that's okay. I'm down 16% year over year. But let me just show you something about how volatile my portfolio is. And let's go back to October 8th, 2021. On October 8th, 2021, I had $166,000 in my portfolio. On November 8th, I had $297,000 of equity in my growth portfolio. That means I was up 79% month over month from October to November of 2021. And then in December, just a month later, December 8th, 2021, I had $204,000 of equity in my growth portfolio. That means I was down 46% from November, month over month. But then we go back to February of 2021. I had about $346,000 of equity in my growth portfolio. More than 100% from January 1st, which is when I had about $183,000. So my portfolio really is incredibly volatile. From any given month, I can be up 100%, 50%, or down 50%, right, as we saw in December. But I believe that over the long term, eventually my investments, the equity that I'm building, will become exponentially more valuable. Just like the hockey stick. As an investor, you want to invest at the low point. You're going to experience the volatility. It's going to go up and down. In due time, once your investments, once your companies start to realize their potential and their mission, you'll see that you'll go from this little frequency to massive jumps in your portfolio, and you'll start to build up that hockey stick. That's really what you're working towards. You don't want to just go like this immediately, because you want to acquire more equity. That's the goal. Equity, ownership of the company, building up more equity. And the earlier you get in, and the more you stay, the longer you stay, the more shares you can acquire at a cheaper rate before it realizes its potential. So yes, I am down 15% year over year, and I've been up about 100% within a single month, any given month. In a single day, I can go up 25% or be down 30%. So that's how my portfolio works, but we're not done yet. If you thought those were crazy numbers, let's jump back to May 22nd of 2020. In May of 2020, after the first full year of investing in the stock market, I was up about 120% from the previous year, 2019. So in May of 2020, May 22nd to be exact, I had $11,000 of equity, according to my Robinhood graph, which changes because I move money in and out based on different investments I have to make, like buying this house last year. But what really matters is the percentages, which is what we're going to talk about right now. So on May 22nd, 2020, I had $11,000 of equity in my growth stock portfolio. That's 2020. So fast forward a year, on May 21st, 2021, I had $163,000 of equity in my growth stock portfolio. That's equity. That accounts to 1,382% of year over year growth in my stock portfolio. Yes, that number is correct. I did not screw that number up. That is about 15x growth from 2020 to 2021. 15x in 1 year. Show me 1 year that the S&P 500 did that. To the commenter who said I should have just stuck with the S&P 500. That's why I don't stick with index funds. That's why I don't over diversify or diversify at all, right? Because you get the average, you get the mediocre. That's fine over the long term, but you need to have a lot of money if you want to retire early. And you need, in order to get a lot of money without drastically increasing your income, is by investing more aggressively so that you can get more gains earlier, so that you can invest it in more higher return investments sooner, so that you can build up a larger amount of wealth over the long term. That's how you retire early. The S&P 500 will allow you to retire eventually at 65 or 70, 50 if you're lucky. But picking your own companies and investing in a more concentrated manner and more aggressively will allow you to retire before you're 40. So you can't really argue with 1,382% returns in a single year. You don't get that from the S&P 500. In fact, let's do the math. In that same time period between May 22nd, 2020 and May 21st, 2021, what did the S&P 500 do? I did about 15x, 1,382% returns. What did the S&P 500 do? So I haven't seen these numbers until now that I'm just looking up on Google, the SPY index, right? The one that tracks the S&P 500, SPY. Great investment if you want to invest more with less risk for the longer term, right? That's fine. This is good. You should invest in this if you don't want to pick your own stocks. It's investing in your own companies, picking your own stocks. It's not for everyone. It's highly risky, but it has more rewards. But if that's not what you want, this is great. So I'm not trying to decry and put down the S&P 500. I'm just trying to make a point here about the math, right? Just to prove my point. So May 22nd, 2020, S&P 500 at SPY was at 295 points or 295 USD. Let's fast forward to May of 2021. May 28, 2021, SPY S&P 500 was at 406 220 points. So what is that math? 295 to 420. Let's go to our handy dandy percent calculator and put in 295 for our first value and 420 for our second value. Year over year, the growth there is 42%. It's wonderful. That's actually amazing because the S&P 500 averages about 7 to 10, 12% over the last 100 years. So 42% is very good. That's growth investment level good, right? That's amazing. But for the record, setting the record straight here, which I don't do often because I don't really care to, but I need to do it once in a while. So because if I don't tell my story, somebody else is going to tell it, and they're going to tell in the comments. And I need to, of course, grow this YouTube channel. So people need to respect my record, my performance record, right? So I want you to understand that I'm not just saying stuff. That when I tell you to practice the bull mentality, I mean it, right? So S&P 500 did 42% year over year between May 2020 and May 2021. Same time with COVID and all of that, they had the same market influences. The world economies were shut down. Everyone's moving to the internet, Zoom, and all of that, right? They had all of those advantages or disadvantages that I did in the same time period. So all else is controlled for. The only thing that's not the same between S&P 500 or any other index fund in my portfolio or any other hyper concentrated portfolio that's investing aggressively for growth and in a concentrated manner is exactly that, the concentration. They have 500 stocks. I had about 12 in 2020 and then down to about 7 or even maybe 5 at this point in May 2021. That's the difference. I had about 100 times less stocks than they do. So what was the difference in the performance? They did 42% according to our math in the percent change calculator from 295 to 420. I did from $11,000 to $163,000 in a year, which came out to 1,382% year over year. That's the bull mentality in practice. I find great companies that I've known of. I do my best to understand them by doing the research. And once I understand them, understand what they do, why they do what they do, what the future holds, then I believe in them. I believe that they can get us there to that future. And I believe that they are the best suited to achieve that goal and realize the future that I believe will be. And then I hold them for the long term, for as long as my investment thesis stays true, that they are the best for my growth portfolio and will help me get to my retirement goal. I hold them. And sometimes I reassess every quarter, every 2 quarters, every year. I reassess, make sure my investment thesis still makes sense. And if it doesn't, I cut them. And my goal at all times is to concentrate more on less companies, because the more I concentrate, the less companies I have in my portfolio, the more I can focus on the few of them. Because I only have 24 hours in a day. Actually, I only have about half of that. Probably less, right? Because I have to sleep and work and eat. So I don't have much time. I've done the math on exactly how much time we all have in a day to do research and understand the companies and understand our investments, the companies that we're invested in. It's not very much. And the more companies you invest in, the more you spread out that very finite amount of time that you have to do research, which means that your research will not be adequate for each one. You will miss things because you're spread out across 20, 40, 50, 100 companies. You can't possibly understand all of those companies. You can't possibly understand even 50 companies or 20 companies. You can't keep track of all of those. I know I couldn't. I couldn't even keep track of 10 companies. I have too much going on in my life to keep track of 10 companies. I could do much better with 5, half of that. I know that much for sure. I can do even better with 40% of that, or 60% of that at 3. At 3 companies, I can do adequate research in the very short amount of time I have to a lot to those 3 companies. So I have more information. I have better, more accurate information. I have more passion for each one of these companies. And I have all the resources I need to dedicate to them. And because I've dedicated so much of my money and invested so much of my money into each one, every single move that they make will return me much more than if I spread out that same amount of money over 10 companies who all move a little bit. So if I moves $1, I get $12, right? In either direction. It could go down, right? I could lose $12 as well. But my belief is that over the long term, I'm going to gain much more than I'm going to lose. If one of these 3 companies fails, okay, fine, I messed up. But I'm only 28. I have enough time to lose all my money and start over. But the chances are that I won't lose all my money. And that chance is asymmetric risk, which is the holy grail of investing. Asymmetric risk says that, as we've covered on this channel, that I keep saying is highly important that you watch our video on that. Probably the most important video that you will watch. Not my best video, but the content is the most important that you will watch. Asymmetric risk says that if you have a higher chance of and a greater potential of upside returns, you take that bet because you have a greater chance of seeing greater returns than you do at losing money. So if I have a greater chance of getting 100% returns than I have of losing 50% of my money, I'm taking my higher chances at that higher reward any given day, especially if I'm young and I have a good amount of time to lose that money. And that small chance that I do lose that money, I have enough time to pick myself up and try again. And then I see another opportunity that says you have a exponentially higher chance of seeing a 300% return or 10x return than you do of losing 100% of your money. I have a 20% chance of losing 100% of my money, or even 80, 50%, versus having 80% chance of 10x in my money. I'm taking that 80% chance any given day. And that's how I see it. That's how I approach investing. I risk losing everything that I have, all my money, so that I have a chance, which is much higher, of multiplying my money. So that I have a higher chance of retiring, and retiring early on my terms when I want to, in the way that I want to, so that I can live my life the way that I want to and enjoy the company of the people that I love, that I want to. So if I can get a 1,382% return in a single year with a chance of losing 100% of my money in that same year, a smaller chance of losing my money, I'm taking my chances of that 15x return in a single year. I'm taking that. That's just me. I have a higher sense of confidence than most people, and I understand. That's fine. I mean, that's me, right? I'm not gonna shy away from that. But I understand as well that not everyone has that inflated confidence, right? I've made choices in life, and it's gotten me where I am today. I have a pretty nice house. My family, I love my family. We're all doing well. I'm not hurt. I have a nice career, make lots of money because I worked incredibly hard in college, harder than people wanted me to and were willing to themselves. And that got me here. Those are choices that I made. And I changed my major multiple times to get to the major that made sense for my future that I wanted, right? So I've made very tough choices over my short life that's been 28 years. And I've arrived here. And I like where I am. So that gives me lots of confidence that I know how to make the right choices for myself and make good judgments. So when I choose 3 companies, I'm pretty confident that at least one of those are the right ones. And I'm still very confident that at least 2 of them are going to do very well. And if I get all 3 right, which is unlikely, I understand, but if I get all 3 right, then even better. But all I need to get right is 1. I just need one of them to be right. And I'm pretty confident that one of these 3 that I have on this paper are the right ones. And I'll share that with all of you, as I do with my patrons at patreon.boacademy.org as sometime this year. I've done a portfolio review since my portfolio reviews on my $65,000 to $107 to $155 to $255,000 portfolio. I missed my chance to do a portfolio review when I had $355,000, $348,000 last year, as Lucid Motors ran up. But I didn't do that because I didn't want to just show a momentary high that I knew was gonna very soon fade, which it did, right? So I share my portfolio updates with my patrons in our Discord channel. As soon as I make any new buys or sells, I tell them. So that's one of the benefits of being a patron. If you want to join us in our Discord community and chat with us and share your own thoughts, ask questions, and just collaborate and be in community with other investors who are on similar goals and a similar journey as yourself, then join us over at patreon.boacademy.org. You will be, in the same time, helping me make more videos because I need finances. I need the money to support this channel, right? Buying all these equipment and all of that. And all of that has been possible thanks to our patrons. So all of you in our Patreon community, I appreciate you again. I want to make that very clear that you all make this possible. So thank you. And I want to end the video by saying, yes, I am down about 15% year over year as of now. That might be true, or it might even get worse in the short term. But I'm not investing for the short term because I know that's not the right way to invest. That's not the best strategy. When you have short-term incentives, you have the wrong incentives because you don't know what's going to happen in the short term. You could bet all your money and hope that some short squeeze or whatever happens, as you saw with GameStop or AMC or Dogecoin. You can hope that happens to your pick, but it is astronomically low of chances that happens to you, that you pick the one stock or one crypto meme coin that blows up. It's incredibly, the chances are near impossible for you. So I would say it's not worth trying. That's just me. I'm not really a betting man when it comes to the short term because I don't have a fortune cookie. But what I do have are perspectives on this world from my time on this earth and the things that I've done. And I've done lots of different things in my life, right? I've acquired a diversified array of knowledge and experiences, which is why as I've explained in a previous video on the jack of all trades and the beauty of diversifying your knowledge so that you can concentrate your investments, because the more knowledge that you have, the more you can concentrate your investment. And that's just what happens. We've seen it over and over again. Everyone says it. Warren Buffett says diversification might maintain wealth, but the way that you build wealth is through concentration. This is a known truth. I'm able to do that because I am focused on the long term and not trying to rush to get some incredibly quick win. And because my perspectives tell me that the future is bright and I have a view on the future that is going to be electric vehicles, that is going to be a more fair, equal, just world with more opportunities for more people, more equal opportunities. And I believe in the companies that I've chosen to get us there, in their management teams, in their technology, their competitive advantages. And I'm willing to wait for that to happen because I have time. That's why I don't mind being down in the short term. That's why I'm actually happy. Because as I said many times on this channel, it's all about the equity. The more you can acquire in shares of the companies that you invest in the short term at cheap rates, the better your returns will be over the long term once it starts to actually move and achieve its mission. Because you will have more shares and your cost basis will be lower. So you don't want your companies to run up incredibly fast in the short term. You don't want that. It doesn't make sense for you because that means you have to pay more to acquire more shares. Your goal should be to acquire more shares at cheaper rates, not higher rates. I'm not very happy that one of my top companies that's been in my portfolio forever, which is Cloudflare, it ran up. I started buying it at $15 per share in 2019. And then COVID came. I didn't see this coming. I didn't even take the time to even think about it because I'm not Nancy Pelosi. I didn't have a chance to know that we had some pandemic that was coming to our country and was going to cause everyone to make a abrupt shift to the internet, which is where Cloudflare runs the world. The traffic, right? Because they speed up the internet. I've already made this video too long, but if you want to understand what Cloudflare does, you can go watch that video. But I knew that Cloudflare would run the show, but I didn't realize that it was time people were going to move to the internet so quickly, right? Everyone on Zoom and remote working. And then Cloudflare ran up 10x before I could buy more shares. And so I got bought out. I got locked out of more shares because now to buy more shares of Cloudflare, I have to pay 10x more than I did the year prior. That is not good. I don't like that because I want to spend all this time buying more shares before it achieves that goal that I see in the future. So that's an example of why you don't want your companies to run up so quickly. Of course, I'm on a dollar cost average up. I've been buying more, but now my amazing returns in Cloudflare have come down to more moderate returns because I got rushed on and missed the boat. And it happens. So don't be so eager to see your stocks run up 10x in a single year. It's not what you want, despite what all of the gurus on TikTok and Instagram and all those other platforms say. They're not telling you the right thing. That's misaligned incentives. Your incentives are not aligned with theirs. Theirs are not aligned with yours, right? You're on a different journey. They're trying to make content and get lots of clicks. You need to realize that that's not how real investing works. So eventually I want to see Cloudflare go up, right? But I want this steady hockey stick. I want to be able to invest here and then see it go up, right? So I've said enough. I think the record's straight now. If you have any thoughts on this and want to share your own approach to investing, I would love to hear from you. That's the point of the channel, to really foster community so that we can all understand different perspectives. If you disagree with me, I would love to hear from you too, right? I don't believe that I am all knowing. I'm not a guru. I'm just another person on the internet. Will share my own thoughts, and I would love to hear yours. And I would love to hear everyone else's different perspectives, different stories, different journeys, different ways, approaches to invest in, so that we can all learn from one another and have a better chance at building upsized wealth, right? Long-lasting, sustainable wealth that will enable us all to retire on our terms when we want to, so that we can enjoy our lives before we are old and can't really enjoy it as much as we will be able to when we're young. So that's all for now, really, but I want to leave you with this. Between May 2020 and May 2021, I was up 1,382%. That was my second year on the stock market. I think that's pretty good. I'm down now 15%, 16% between January 1st, 2021 and January 1st, 2022. I think that's also a fine stat. That's how the stock market works. It goes up and down. And the sooner you understand that, the better chances you'll have at success in the stock market. So, lastly, remember to practice the bull mentality. The bull mentality is that we know what we invest in, we understand what we invest in, we believe in what we invest in, and we hold for the long term, because that's how we build wealth. That's how we give ourselves the best chance of success in the stock market. So that's how I plan to continue investing, patiently, because that's the lever that we all have to transfer wealth from the impatient to our own pockets. The people who are out there trying to chase the get-rich-quick schemes and the next meme coins and meme stocks, they might appear to be winning right now, but that's not going to be for the long term. That's not going to last, because that's just not how investing works. Some of them, a very few of them, will be smart, sell, and take their gains and put it into longer term investments. That's fine. If you are able to make a nice trade and get quick money, but you know how to understand that wasn't skill, that you just got lucky, and then take that win and put it into a longer term investment, then you're smart. Then you deserve what came to you. And I'm very happy for you if that's you. I applaud you. But don't be one of those people who think you're going to continuously get those big short-term wins and that it's all skill for you, because it's not. But if you're smart, you'll take that money, put it into a long-term investment. If you aren't trying to pick your own stocks, you'll put it into S&P 500 or some other index fund and hold it for long term and not blow it on some nice new toy. So that's all for now. Thank you for watching. I really hope you enjoyed it. If you did, do me a favor, like the video, share with a friend, subscribe to the channel, comment your own thoughts below, hit the notification bell, all of the stuff on YouTube. Do all of that for me and for yourselves. Help your friends, because if you are the only one building wealth in your circle, then you're not really building wealth, because you can't be wealthy if you don't have people next to you when you get there. And you want to be able to take your friends with you. So help them out, share this, help them learn how to invest, build long-lasting sustainable wealth the right way. And of course, if you want to support the channel financially and join us in our Discord channel where we discuss the stock market in real time every day by sharing news, rumors, and new investment ideas, so we can all do our own research and then come back together and collaborate the same way that we did with CCIV last year and ChargePoint and SoFi and all of the others, how we got in early on all of those. Then join us over at patreon.bullacademy.org. You will be doing us all a great service by helping this channel continue to go and grow and help us reach our 10,000 subscriber goal for this year. I'm Lincoln with bullacademy.org. Thank you again and have a great day.